Well, U.S. inflation unexpectedly cooled in April in what economists warn could be a final lull before a potential surge in consumer prices because of U.S. President Donald Trump's trade war and tariffs. Let's get more on the numbers with Olu Omodunbi. He's chief economist at Huntington Private Bank. Olu, thank you very much for joining us. What's your take on these numbers, and was there any evidence of tariff-related price increases?
Thanks for having me. So it was a good inflation report. I think this is another sign that the U.S. economy is in good shape as of spring of 2025. So inflation slowed to the lowest rate since 2021. The labor market is also in good shape. We continue to see solid job growth. So, this again points to a solid U.S. economy. We did see some tariff-related price increases in the April inflation report. So items such as beddings, furniture, audio and TV products, household furnishings, we saw some big increases in prices on a month-over-month basis. But the great news is that we saw slower services inflation, so that also contributed to the good inflation report. So we think that one of the factors which could have been at play is that many businesses loaded up on inventories in anticipation of tariffs. So based on our conversations with businesses, based on surveys, there's also some reference of that in the Fed's Beige Book. So we think that, it could take a couple of months before we start seeing, more impacts of tariffs on prices, particularly goods prices.
And how much of an impact would you expect over the next, let's say, 4 to 6 months from tariffs onto the pace of inflation in the U.S.?
Yeah, so we think tariff policy uncertainty, it's not good for consumers, not good for businesses, also makes the Fed's job more difficult. We think that in addition to the supply side shock, we think that, we've already started seeing consumers, talk about expecting higher inflation about a year from now. So inflation expectations have gone up. And, once consumers expect prices to go up, businesses expect prices to go up, it's not great for the U.S. economy. So we do expect inflation to be above 3% by the end of 2025. We continue to hope that trade talks head in the right direction. In recent days, there's been an agreement between the U.S. and China for a pause of tariffs. So, we continue to expect that we see more talks like that because, that's going to be good for the U.S. economy.
How does all of this look, do you think, to the U.S. Fed? Huntington Bank's call on the Fed is for 2 25 basis point rate cuts in 2025. Those cuts, of course, would be made with a view to stimulating economic growth, and would be made if there was confidence that rate cuts would not spur significant inflation.
Right. So the Fed has a dual mandates, price stability and maximum employment. The great news for the Fed is that we continue to see a resilient labor market. Average job gains over the first 4 months of this year were about 144,000. The unemployment rate is at 4.2%. That's low on a historical basis. So that buys the Fed time to continue to assess the impacts of tariffs on the U.S. economy. And something to note is that, the Fed hasn't faced a situation like this. So, the Fed really, at the previous meeting, Chair Powell said that the cost of waiting are low. So the Fed will continue to take a wait-and-see approach until they get more clarity on the impacts of tariffs on the U.S. economy. We do expect to see softer labor market conditions through 2025. Monetary policy is currently restrictive. The Fed's funds rate is between 4.25 and 4.5%. We have seen some slowing in labor market conditions over the past couple of years. The GDP print for Q1 came in negative. We did see net exports disrupt economic activity in the first quarter of this year. So there are several signs that the U.S. economy has lost momentum in recent months. We expect to continue to see softer labor market conditions through 2025. and that should put the Fed in a position to cut rates by 25 basis points twice before the end of 2025.
You make a good point, or you made a good point in that answer. You said the Fed hasn't seen situations like this before, the situation being the tariff, the unprecedented immediate dialing up of tariffs by the U.S. administration. Nobody else has seen this before either, including economists like you. How much potential is there here for outcomes that are not yet, are very difficult to predict?
It makes forecasting more challenging, because as of late 2024, the U.S. economy was in good shape. Economic growth was about 3% in 2024. It was at about the same pace last year in 2023. The labor market was in good shape. So this is different from the closest scenario, which was during the pandemic when we saw supply side shocks, but then we saw a positive demand shock. So we saw turbocharged demand for goods, and that contributed to high inflation. So it remains unclear how consumers will react once they start seeing the impacts of tariffs on prices. Our baseline expectation is that we see slower GDP growth this year. So we expect that we're going to see some pullback in consumer spending. But again, we do expect that we're going to see continued expansion through 2025 and softer labor market conditions, which should help the Fed cut rates by 50 basis points before the end of 2025.
Olu, thank you very much for this conversation. Olu Omodunbi is chief economist at Huntington Private Bank. Well,